Greetings, everybody. Welcome to Liberty Call. It is Tuesday, November 15th, 2022. Hope everybody's having a good day out there. Another back and forth day in the markets. The Dow was, started out in the green, went into the red, and then back into the green. So looks like the traders out there in the world just can't make decisions on whether they want to buy or sell. So anyways, if it's your first time watching, please give me the big old thumbs up, like, share, subscribe. I'd greatly appreciate it. And let's go ahead and jump into today's numbers. Let's see, Dow Jones finished the day up 0.17% or 56 points at 33,592. S&P 500 was up 0.87, closed at 3991. NASDAQ was up, and tech was the big, which basically pulled up most of the market. It was up 1.45%. Closed at 11,358. Small caps are up the same, 1.45%. The VIX was up today, 3.41%. It's currently at 24.54. It was as high as, I think, almost 6% earlier in the trading day. All right. Canada was up 0.37. Brazil was up 0.81. Mexico down 0.21%. Moving over to Europe, Germany was up 0.46. UK was down 0.21. France up 0.49. The Euro Stoxx was up 0.71. Netherlands was up 1.38. Spain up 0.27. Let's see here. Italy up 0.42. Switzerland up 0.24. And Portugal up 0.67. So a pretty good day across Western Europe. Moving further east, both Russian exchanges were in the red. The MOEX was down 0.96 and the RTSI was down 0.89. And headed over to the Asian markets, I see a lot of green there. Japan was up 0.1, Australia down 0.07. Let's see, New Zealand, it says flat. Maybe their market is open right now. The Shanghai in China was up 1.64. The SESE component up 2.14. China A50 up 1.6. DJ Shanghai up 1.84. The Hang Seng was up 4.11, and the Taiwan weighted came in down 2.55%. So, like I said, pretty good day across the board, but there definitely were a few that were some laggards out there. All right. Well, let's go ahead and jam through today's market recap. S&P 500 resumes uptrend after paring gains on report of Russian rockets in Poland. Yeah, if you haven't been watching the news today, evidently 2 rockets landed in Poland. What I've been seeing on the TV over here is that supposedly they're from Russia. I'm going to withhold judgment until I have more details. All right. The S&P 500 resumed its trend higher Tuesday as focus returned to signs of easing inflation following a dip earlier in the day on news that Russian rockets had crossed into NATO member Poland. 2 stray Russian rockets landed and killed 2 people in the NATO state of Poland, Associated Press reported, citing an unnamed U.S. intelligence official. Well, if it's an unnamed official, you got to believe it. The Polish government called an urgent meeting of the National Security Committee. Russia's defense minister denied its missiles had hit Polish territory, calling the reports, quote, a deliberate provocation aimed at escalating the situation, end quote. The news had briefly stoked geopolitical tensions, briefly lifting demand for safe haven treasuries and the dollar, but the safe haven move faded and stocks resumed their rally amid signs that inflation is cooling. The producer price index only rose 0.2% in October, well below the 0.4% rise expected, reinforcing, quote, the notion that peak prices are behind us, end quote, Stifel said in a note following data last week showing slower consumer prices. The data added to growing expectations for a slower pace of rates, with just 19% of traders now expecting another 75 basis point rate hike next month, down from 48% the previous week, according to Investing.com's Fed Rate Monitor tool. As Treasury yields slipped, tech stocks advanced. Meta Platforms and Alphabet jumped more than 2%, with the latter attracting the attention of activist investor TCI Fund Management calling on the tech giant to cut costs and boost share buybacks. Chip stocks also played a big role in the broader melt up in tech, led by Taiwan semiconductor manufacturing, after Warren Buffett's Berkshire Hathaway took more than a $4 billion stake in the chip maker during the third quarter. The stake in Taiwan Semiconductor from the Oracle of Omaha boosted sentiment on the chip sector, sparking a wave of bullish bets on other chip makers, including AMD, NVIDIA, and Qualcomm. Walmart rallied 7%, triggering a sea of green in retail stocks after upgrading full-year guidance following third-quarter results that topped Wall Street estimates. The better-than-expected results were driven by strength in Walmart's food business, underpinned by strong consumer demand for lower-priced groceries. Home Depot gained more than 1% after reporting quarterly results that topped estimates, though unchanged guidance took some gloss off the results, quote, given high investor expectations surrounding the quarter, end quote, Goldman Sachs said in a note. All right, so mostly good news out there. So let's go ahead and dive a little deeper on the producer prices. Slower U.S. producer price growth adds to improving inflation outlook. The U.S. producer prices increased less than expected in October as services fell for the first time in nearly 2 years, offering more evidence that inflation was starting to subside, potentially allowing the Federal Reserve to slow its aggressive pace of interest rate hikes. Again, if you've been paying attention and following along with all these articles that I read on a regular basis, the financial journalists are just hell-bent on, stopping the rate increases and, lowering rates back down, which I personally don't see that happening anytime soon. The report from the Labor Department on Tuesday also showed a decline in the cost of wholesale goods, excluding food and energy, reflecting improved supply chains as well as slowing demand from higher borrowing costs. This supports economists' views that goods disinflation was underway. Quote, this report will add to the narrative that inflation has peaked and in particular that pressures from the goods sector may be easing, end quote, said Conrad DeQuatros, senior economic advisor at Breen Capital. The producer price index for final demand rose 0.2% last month. Data for September was revised lower to show the PPI rebounded 0.2% instead of the 0.4% as previously reported. In the 12 months through October, the PPI increased 8%. So again, things are 8% more expensive for producer prices than a year ago. So again, the rate of increase is slowing, but at the same time, I don't really see any disinflation out there at this point. So again, slow your roll, folks. Let's start to see some drops in these numbers before we go around, patting each other on the back too much. That was the smallest year-on-year increase since July of 2021, followed an 8.4% advance in September. Economists polled by Reuters had forecast PPI rising 0.4% and advancing 8.3% year-on-year. So, all right, so that's basically all the details there and everything that I was going to cover. Oh, no, I have one more article here. See, I'm getting ahead of myself. Anyway, so again, I don't want to, always be the Scrooge or the, bah humbug guy. But, again, it is an improvement. So I don't want to poo-poo all over that. But at the same time, things are still getting more and more expensive right now. So until I really, like I said, start to see some disinflation, I'm not really too excited. All right. So next article up, or last one, U.S. household debt jumps most since 2008, even as credit card rates surge. So I don't know if this is good news or bad news. In my experience when I worked in the credit and collections aspect of, personal finance back, decades ago, typically when, credit card balances start to swell, then, the real sign is, how much, what percentage of accounts are in delinquencies. And when those start to go up, that's usually a telltale sign that the economy is not in the best shape. So, all right, let's dive in. U.S. household debt climbed at the fastest annual pace since 2008 in the third quarter, with credit card balances surging, even as interest rates that lenders charge to consumers hit multi-decade high. Households added $351 billion in overall debt last quarter, taking the total to $16.5 trillion, according to data released by the Federal Reserve Bank of New York on Tuesday. That's an increase of 8.3% from a year earlier. And it kind of matches the inflation rate. So it looks like people are just taking those extra costs and putting them on credit cards at this point. The most since a 9.1% jump in the first quarter of 2008. The debt figures aren't adjusted for inflation. Most of the latest increase came in mortgage debt, by far the biggest liability on household balance sheets. It rose by $282 billion in the third quarter and by $1 trillion from a year earlier. to 11.7 trillion. Mortgage and home equity debt combined are up by 2 trillion since the pandemic began. Excuse me. Credit card debt also increased by the most in 20 years, with balances rising by 15% from a year earlier. The surge comes as the average interest rate on card borrowing has climbed above 19%, the highest in data going back to the mid-'80s, according to Bankrate. With prices up more than 8% from a year earlier as of the quarter's end, it's unsurprising that balances are increasing. Fed researchers wrote in a blog post, quote, "The real test, of course, will be to follow whether these borrowers are able to continue to make payments on their credit cards," end quote. Delinquency rates are currently low by historical standards, as many households saw their finances cushioned by pandemic stimulus and savings during the lockdown. Again, that was 2 years ago. I'd be shocked if most people had that still tucked away for a rainy day. Still, there are signs of, quote, disparate impacts of inflation, end quote, in the debt data, the Fed researchers wrote. Credit card balances increased more for borrowers between the age of 30 and 59 and those in low-income areas. Those groups now owe more than they did in December of 2019. By contrast, older borrowers between ages 60 and 79 and those in higher income areas still have balances that are below pre-pandemic levels, the researchers found. There are 191 million Americans with at least one credit card, according to the New York Fed. Many have more than one. The total number of accounts is estimated at 555 million, up from about 100 million by about 100 million from 2016. In addition to levering up on credit card debt, Americans are also tapping home equity to help meet spending needs. For the second consecutive quarter, home equity lines of credit increased. Auto loan balances rose by 22 billion in the third quarter and now above 1.5 trillion, roughly double the figure a decade ago. Well, cars have gotten a lot more expensive in the last couple of years, so that might have something to do with it. With payments and interest on student loans frozen during the pandemic, card debt is on track to overtake them as the second biggest liability for U.S. households after their home mortgages. All right. So again, just something to pay attention to. If you start seeing articles that there's a lot of delinquencies out there, that is again a telltale sign that things are slowing down. So just keep your ear to the ground, pay attention to what's going on, and try to be as nimble as possible in this not stable environment that we have going on right now. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Hope everyone has a fantastic evening, and I will see you next time. Bye-bye.